All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Quite the interesting action in the market since I was last on video. We saw the market essentially melt up into the close yesterday, where it rallied about 70 points into the close in the last hour. From 24.10 up to, about 60 points there, 24.70. So massive rally into the close, put the S&P up over 100 points, the Dow up over 1,000 points, made for some great headline fodder, right? Those headlines were out there. And, it was one of those where even a family member to me yesterday who has nothing to do with the market, saw it and said, whoa, is something really changing here? And my response was simple, and it was no. In fact, I think overall yesterday might have been a worse day for the bulls than a 20-point up day. And one of the reasons I say that is because when we look at tendencies, when we look at market tendencies and volatility tendencies, there are a few things that are very common, are very usual, that we see happen when markets go from bearish to bullish or bullish to bearish. And yesterday fed more fuel into the bearish fire, even though the market was up. And I know yesterday kind of is going to go down historically as one of the biggest rallies in a long, long time and all of that. But you look historically at the biggest rallies in the market, they happen smack dab in the middle of strong bear markets. They don't happen at the beginning. They don't happen at the end. They happen smack dab in the middle of very strong bear markets. And that is something that I can't emphasize and stress enough. And yesterday, I made the comment on Monday that I think the market, put the lows in for at least a little while, and that path of least resistance was higher. We saw 100 points up yesterday, okay, great. But I don't think we're seeing a turn from bull to or bear to bull. And, today I think could be argued that today is actually more bullish than yesterday in terms of what we see going on internally, right? Now, granted, most stocks are down, most stocks in the red and all of that. And absolutely that's what we're going to see with the market down, 50 points, 47 points here. But overall, there's a few things to keep in mind around this, around what's going on here. Number one, think about investors, right? Investors drive bull markets, okay? Investors drive bull markets. Investors, they don't really drive bear market volatility. That's a lot driven by algos, by short covering, by panic selling. And yes, investors are part of that. But when we see investor-driven markets, right, they tend to be markets that are more stable, more certain, and they tend to have much more of a fundamental nature to them. When we go into bear market, that stuff goes out the window, right? And it's not driven. The movements are day-to-day movements are not driven by investors, right? And so what do we need to see for investors to jump in, right? Are investors jumping in yesterday? Is that what we're seeing yesterday? Investor movement here? No, not at all. Not at all. But investors need a couple things. They need the environment to go from uncertainty to certainty, right? They need some known variables. Now, nothing's ever totally certain out there, but what is the movement? Where is the market been going? Well, the market has been moving in the last 3 months from what? A pretty certain market to a very, very uncertain market. And uncertain about the major drivers, macroeconomics and earnings. Did yesterday do anything to change that uncertainty element? No. In fact, it added another brick to it. It just added more insane volatility. That's what it added to it. So yesterday, we did not see the market go from this kind of relatively uncertain environment and become more certain. there wasn't a macroeconomic or earnings driver to it. Had there been a macroeconomic or earnings driver to it, it's a different story. But overall, the context did not change for investors. Right? There's no real change for investors. One of the reasons I say today might be a little bit more bullish than yesterday in terms of its implications going forward is the fact that what's happened to the volatility today. Just the pure movement in the market. Well, it's dampened. It's a lot more tempered than what it has been. I mean, the market's moving within about a 30-point range here today. So a lot less movement, at least so far. Now, I'm not talking about implied volatilities and option volatilities, which are surging today, but just overall price movement. That's one area where investors are getting and starting to see a little bit of calm, at least for a few hours, right? But investors need to see that over time, and we're moving from a period of incredible uncertainty and really not moving into any kind of certainty here. Last week you heard me talk, I think this earnings period is going to be a really big one. And one of the reasons is because it's the only real catalyst out there that can drive some certainty. And if it's able to drive a little bit of certainty, the fundamentals will come back, investors will come back, and you'll see the market, really turn around. Without that, though, you can't look at a 100-point update in the market and go, ooh, okay, that's all of a sudden now the bulls are in control. No, because that drives what? Even more uncertainty, okay? And I think that's a very big tendency to keep in mind, and it's one where when we look back in history, right, and, we're going to go do some historical looks here, but when we go back in history, we will see many days like the one we had yesterday. Okay, we will see many days like that, and they're not all followed, by strong bullish upticks. It's not always a day where, oh, okay, now you can look and say, hey, the bulls are in control. Yesterday was what type of movement here? We're talking about about a 5% move in the market. Okay, about a 5% uptick, and so pretty historic day. But one thing to keep in mind is we had one of these days earlier this year. Right? It wasn't, the market didn't end up 5%, but the market gapped down, and from its lows to its highs, it was about a 5% move. Right back here in February. Pretty big move. Everything good to go? No. Market pulled on back, and then had another day where it had a 5% range on that day, right? What's going on volatility-wise here, right? What's going on? It's not changing. It's not going from from uncertain to more certain. Now, this was a much more shorter-term pullback. We did have a catalyst this next day that created a gap up and created a little bit of short-term bullish momentum. But as the market went forward through this small correction, you'll notice that even right here, it's not quite as big as yesterday was. But we're still talking about a pretty monster uptick and pretty monster move. What happened the next day? Up. Next day, big down. Right? My point here is these monster upward moves, they don't do anything to quell the volatility. And so one of the things that we will see, and we see historically, is that these monster up moves tend to get sold into to some degree or another. And the ones where the lows from that day are not taken out, those tend to kind of have stronger bullish momentums afterwards. The ones that have the lows taken out, they tend to have a lot more volatility carry on and continue going forward. But we've seen this even this year, right? Now, it's not this day is not historical because it gapped down and rallied. Yesterday gapped up and rallied. So a little bit different on the headline percentage element there. But we have seen it this year. Now, if we go back and we go back into what this is really comparing to. And I know the bulls don't like to compare this to 2008 and 2009, But when we start talking about the price action, it's similar, right? It is absolutely similar. And so if we're going to look at market tendencies, we really need to kind of at least examine back here. And here we are. Here we are. Now, we're not going to be talking about the S&P moving 100 points, but take a look at this day right here. Here in October. The market closed at, the SPY at 720. Next day at 820. This is a 100-point day on the SPY, a 100-point day on the SPY, and after a huge bearish move, right? I mean, the market was basically cut in half from its highs. So we're talking about a stronger move down than what the current market has seen, a just absolute gigantic upward move. Then what? Volatility go away? All of a sudden, everything changed for the bulls and everything right for the bulls and ready to go for the bulls? Not at all. Not at all. We can go even further here, right? We can come in and look in November. Some monster rallies. Here we have a rally where from 64 to 69, right? That's about what we saw yesterday. Actually, a little bit greater than what we saw yesterday. Monster rally. Volatility over? No, not at all. The volatility is still very heavy, very hefty. Now, can you start talking about the level that big move was created off of and that level mattering? Yeah, you can, right? You can start talking about those types of things. But, these massive moves to look at and say, all of a sudden, okay, now bulls must be in charge again. That's not historically what we see. We can look at it right here. I mean, this was a monster move in the market. 68 to 76. I mean, that's over a 10% move in the market. And yet, the market trickled on higher for the next few days. All well and good, all over volatility. No. I mean, here we have a day where, market not as big of a move, but similar to yesterday's move. And, all well and no. Right? So what's my point here? Well, my point is when we go back and we look historically at moves like this, and we can go back into 2007, we can take a look like we did here in 2008. We can look at 2011, which had a little bit of some of this, right? Even 2010, albeit not to the exact same degree. A move like yesterday, it's not an all clear sign for the bulls. Never has been, probably never will. And that is because we're not seeing the volatility compress in any way, shape, or form. Now, is it part of creating a bottom? Is it part of potential bottoming process, or type of bottom for individual names? Yeah, it can be. It can be. And historically, when we start to see some of these huge rallies, we're starting to talk about levels that matter. But even here in 2008 to 2009, if I come in here and just take and extend this out into 2009, you'll notice that the big up days that we had, right? These weren't bottom markers to speak of. These weren't levels that weren't going to be retested or couldn't be revisited. They were absolutely retested and revisited. And when you look at the bottom here in 2009, did it have a massive monster upward day to define that, okay, bottom's in? No, it didn't. It absolutely did not. What did it have? It had an upward day. It had a nice kind of just upward day right here. And then it was followed by a stabilizing day. Market small gap up and then really didn't go anywhere that day. That day gave investors a little bit of confidence that, maybe we have some stabilization, but not full on. Not everybody jump in the pool. The next day we get another nice upward day, but not too hot, not too cold. And we get a couple stabilization days, another few up days. All right, the market finally has some sell. Okay, it's not the end of the world. Gap up and, oh, wow, okay. We're actually seeing buyers start to step in. We're seeing a little bit of a different story start to take place and start to transpire. Lows that are sell-offs are still happening, and they're still pretty big, right? 7% in 2 days. But we're starting to set higher lows. The volatility is actually compressing rather than expanding. And that is a very big difference. And so when we go and look, and I think this sell-off in the market in many ways can be compared to the financial crisis in terms of some of the uncertainty build that is absolutely out there. Now, what's different between right now and the financial crisis and other bottoms of bear markets? Well, one of the tendencies in the bottom of bear markets is you get this area where, in fact, you get these areas where everyone starts talking, man, the market's cheap. The market's really cheap. They're a really inexpensive market. Look at these metrics. Look at these fundamentals. They're really cheap. Then you get another move where they get a lot cheaper. Where what was cheap becomes just insanely cheap. Nobody's buying cheap. Nobody's buying, nobody's buying the ATTs of the world. Nobody's buying the inexpensive stocks out there. They look at BTU at a PE of 2 and say, oh, okay, better sell it. There's something wrong with the stock because it's so cheap. Right? That's what happens. There's this mentality of there's something wrong with the stock because it's too cheap. And then we start to see some stabilization. We actually start to see some price action come in that's, that has some positive earnings drivers. In fact, right back here, Alcoa was one. We saw a nice positive driver from Apple through this period. And you start to see some of the earnings drivers. And what was really interesting is the earnings outlooks and how they change through this time period, and even through this April period. The earnings outlooks for the coming year were still a lot of uncertain, but the risk started changing to the upside, right? And last earnings season in this market, we saw the risk start changing to the downside. That's one of the reasons why I say, hey, this earnings period is really important, right? If we're still talking about companies talking about risk to the downside, there's another sizable leg coming, right? There's another big leg downward coming. If there's talking about risk to the upside, we're probably near a bottom. But what's my point? My point here is that whatever correction we go and look at, the tendency is that these huge up days are not the bottoms. They're not. I mean, we go look at 2010 and we say, well, okay, flash crash, right? I mean, flash crash 2 days later had a 50-point up day on the S&P, up over 6% on the S&P. Is it all well and good, everything over, volatility over? No, not at all. Not at all. Had big reversal day right here. Right? Yes, they're putting in some levels, sure. But to be able to say it's over, no. When are these things over? You start to get some stabilization days. You start to get days where, you know what, they're not getting sold into. Yeah, the market's up 20 points, but it's not getting sold into to the same degree. Kind of like today. Not getting sold into, but today's just one day, and it's actually a down day. So I think we're talking something more about something like this. But, overall, we start to see some positive drivers, start to take place. And, we saw that in 2011. But the big up days, those weren't the all-clear signals, right? Or 2010 is when we saw that. Here's 2011, right? European crisis, Greek crisis. Look at some of these up days in here. They're monster. They're monster huge days. This day right here. Are they level marking? Yes. Are they all clear? Hey, you're good to go. There's never going to be another sell day? Nope, not at all. Not even close. Right? Not even close. what do we start to do? We start to stack on. Yep, right here was a pretty big up day. We start to stack on a few days, but even on this, there was still another, pretty sizable dip, with a higher low. Bottom line, volatility, the tendency here is that volatility is not going away. The volatility will remain and will remain high. We can look at something like the VIX during periods like this, and you can see how it will stay elevated for a period of time. Yes, it drifts lower. It starts to really kind of creep on lower. Really starts to, yes, there's some big down days here in the VIX, right, as we get a little stabilization. But overall, it stays at an elevated level for a longer time period, as investors are not jumping in, and there's still a big question of uncertainty on the valuations. Now, seasonally, right? We're in the end of a year, right? And every time there's an end of the year, the questions are always, hey, what goes on? What tends to happen at the end of the year? What's what tends to be the price action? Well, most years it can be very different. And, this is one of those years where I don't look at it and say any of these tendencies matter. We can look here at 2010, and, you can see, yep, there was a big up day and then some sell. One of the biggest tendencies that we almost always see, sorry, that's the VIX. Let me show you the SPY. It's going to look a little bit different. Whoops. But one of the biggest tendencies that we see is that the market itself tends to sell off into the last hour of the last day of the year. That is the tendency that is almost, and in the market, you always hate to use the word always, but is almost always on point. Last hour of the last trading day of the year tends to be a sell hour. Am I banking on that this year? No, I'm not, because we can see it as a buy hour from short firms, right? With what has gone on, what has transpired here in the market. And so, we can look back 2012 here. This was a government shutdown. And, government shutting down, markets selling off, sells off into the end of the year. January 1st, or beginning of January, big up day and go. I mean, we've seen all sorts of tendencies or all sorts of different type of price action around this time of year. And, given the overall context of the market, it's not something that I'm going to look at and say, well, I expect one of these tendencies to hold. The bottom line is, for the bulls to take control, they have to take back control of the metrics. And even yesterday, and I made the comment in my note, that the bulls didn't take any of the metrics back. And I know the market rallied another 60 points into the close after I made that comment, but the bulls still didn't take any of the metrics back. And today, if we go and take a look at some of the key metrics that are out there, just some of the real kind of simple ones to take a look at. Here's the bullish percent index. Did the bulls take any control of this yesterday? None whatsoever. 100-point rally in the S&P and the bullish percent index doesn't even move? Seriously? I mean, that is something that, we don't see very often, but is something that, we have seen before, and it's something that is very telling. Now, you could take a look at this bullish percent index, and it is about as oversold as a bullish percent index comes. Right? Let me take off log scale here. But here we are. We're down to almost 10. This isn't Greek Euro crisis territory. This isn't 2015, in elections and Brexit and, China dumping U.S. bonds territory. This is Lehman bear market territory. That's what this is. The bullish percent index has hit a lower low than it did during 9/11, than it did during the bear market there of 2002. Bullish percent index has hit a lower number. That's a degree, that is a magnitude of move that you look at, and regardless of your view on the market, whether you're bullish or bearish or however you look at things, you can't explain that one away. You can't explain that one away. And let's face it, the reality, the only reason it's here is because of utilities, right? Consumer staples. That's the only reason it's held up to this point. It hasn't gone down to the 2.5 that we saw in October of 2008. But we are talking about one of the worst pullbacks in market history that has taken place. Is a 100-point snapback day going to change that? It's not. The tendency is that it doesn't. The tendency is that it just continues to signal high levels of volatility and that we will continue to see those. When I make the comment that during my trading career I've never seen options this bad, I've traded through all of these periods, and options were ugly here in 2008, 2009. They were expensive. You kind of got used to it, but they weren't as bad as what they are now. From the spreads to the prices of the out of the money options, they weren't as bad as what they are now. This is one of the worst, absolute worst option environments that I've ever traded, that I've ever seen. And I think when the data finally comes on out, make or down is one of the most expensive option environments in history. That's what this market is. That's what it has become. And so to look and to say 100-point rally, market is all clear, no. We need to see the metrics shift and need to see the metrics change, and they will. They will have that. They will go through that. And I think you have to be on the lookout for that even happening now, right? It's not going to take a whole lot. In fact, if we see the market gap up 20, 30 points tomorrow and kind of just stabilize, that's probably a pretty good sign. We'll probably see the bullish percent index, move up pretty nicely, and take a much more of a bullish stance. But one of the things I want to show you here are the number of stocks that, let's see if I can get yesterday's data here. But the number of stocks that, crossed the 7-day moving average yesterday, right? And so we'll look at stocks that opened, or let's go stocks that opened above. Well, let's go with closing prices here. So a close 0 days ago was less than the 7-day moving average. So let's go with 2 days ago. It was less than the 7-day moving average. And let's go with 1 day ago. It was greater than the 7-day moving average. So this is just going to look at the number of stocks that moved from below to above the 7-day moving average yesterday. 302. It's a monster number. It's an absolute monster of a number. It's one of those where you generally look at that type of number and you go, there's a major change. This is one of the metrics, and one of the few metrics where you can look at and go, okay, there's something at least here. But it's the only one. It's the only one that we really saw shift in a material way. Even though we talked yesterday about some of the transports and some of the other more aggressive names moving on higher, it wasn't enough to change the metrics in a material way. This is the only one. This is the only one. And it's one where, today there's only 100 stocks trading above the S&P 500. So we have about 200 crossing back down below, right, here today. And that's, typical when there's a ton of volatility. But we start seeing a lot trading above. We start seeing more than half the market trading above its 7-day moving average, with the bullish percent index starting to move up 6 points. Yeah, there'll be a material bounce. There'll be a serious kind of multi-day type of a bounce. Yes, yesterday's a serious bounce. It's a monster bounce. One of the biggest in history. But it's also something that it's a bounce in a bear market. And the overall tendency when we see that type of move in a bear market, those types of moves tend to happen in the middle. They don't tend to happen at the end. And I think that's what we take away from yesterday. That is the only takeaway from yesterday in terms of the overall market. And that's how I view it. Now, for the challenge, I still have cash. I'm still in cash basically here. I have some Facebook that'll expire next week. If Facebook rallies huge, then maybe, but it's got to get over 145. So need a lot of follow through to yesterday for that to matter. So basically, my next trade has to. It's not. It doesn't have to hit, but I need the odds much stronger in my favor than where I have to be a little bit pickier. And as I've kind of looked at the price action on different things, and even taking a look at some of the signals that have come in, and especially where some of the option values are, I haven't had anything that I'm too eager to jump into. Yesterday, though, we did see a lot of stocks for the first time in a long time. They closed above their high from the prior day. That is something we've talked about during the course of this sell-off, and when we see that, that'll be a decent sign that there's some change potentially happening. And we saw that with something like an FCX yesterday. We didn't see it everywhere, right? But we saw it in an Apple yesterday. And so what does it tell me? Well, I'm not going to go and buy into the close yesterday and use the lows of yesterday as a stopping point as, what would normally make sense. But now it tells me I could buy the higher low. If there's a higher low, I can go out and buy that, right? Options are still going to be pretty expensive for it. But here we have Apple, moves on up. All right, it's coming back on down, back below the 7 hour. Okay, fine. Not absolutely abnormal price action. In fact, very normalized. Here we go below. All right, however long it wants to ding around, does it go to 147? Does it hang out at 152? Whatever. But that next, gap above that 7 hour, and strong move above that 7 hour, I can use that as a buy point with whatever this new low is going to be, the higher low. That's what I'll be looking for from the bull side is that higher low to come into play. From a bearish side, that's a little bit tougher in my opinion, just because of how still severely oversold the market is. And the fact that we could still be talking about a very strong bear market, even with 260 being hit on the S&P. And in fact, if 260 is hit on the SPY and there's not a major change in the environment, it'll probably be sold and sold very, very aggressively. So it's one where the bears have to be very careful of the snap. We are in historically oversold territory. Even after yesterday's action, we're still incredibly oversold. And so, to go and buy a really expensive put option, because they're freaking expensive right now, in an oversold position like this, I just, the odds aren't in my favor. You know what, I could be right and look really good, but, it's not one where I can go set up the trade and say, hey, you know what, risk is strongly in my favor. Stocks like Nike are ones that really catch me on a day like today where I start to note them down. Why? Big up day yesterday, very small down day today. Doesn't mean it has to go higher. But when you start to see these names break above yesterday's highs that have held up pretty well, they break above yesterday's highs, there's going to be more buying. The algorithms are going to kick in. Even investors are going to kick in. They're going to start to buy them. And we see that happen, quite often. So a Nike really catches me. Even an Under Armour to a lesser degree. But I think Under Armour is very cheap here. A Bank of America, some of these banks, yes, Bank of America is down 50 cents today, but it's got that same type of action. Though it's coming off of a kind of a multi-year low. JP Morgan, same type of thing. But I think if you're looking and saying, I really want to buy these, take a look at if and when they break above yesterday's highs. And to some degree, if the market were to end down today, to some degree, if they break above today's open price. So something like a JP Morgan that opened this morning around 94.80. 94.82 was the open price. Breaks above that level here in the coming days, can be a very intriguing entry proposition there. But don't be fooled that options are cheap, and you'll need a big move to pay them off to a large degree, and that's pretty consistent everywhere you go. I've been watching the VXX. In fact, I was watching it here. Yesterday it pulled back, but you'll notice yesterday it didn't have a monster pullback. The way that the market had a monster rally, and you'll notice VXX hitting a new high here today, even though the market's nowhere close to the lows from yesterday. And what's that tell you about the market's expectation for future volatility? It tells you the market's still expecting heavy volatility going forward. And, the market is typically not wrong when it comes down to that. There's not going to be any kind of, there's nothing expected, right, here through the end of the year for the market to receive and the market to have that says, hey, this could be a game-changing event, right? There's nothing expected. There could be something that happens, right? There could be something that happens. But what happens, if we do have something that is a game-changing event, you're not going to have to dig in the back pages. You're not going to have to dig and go, I wonder what that is. It is something that will be everywhere. It is something that will be on the front page of ABC News. Not market news, but ABC News. CBS News, NBC, CNN. You won't have to go to CNBC. You won't have to go to, Fox Business. You won't have to go to Bloomberg TV. It'll be on the main pages of the national news that's out there, if there is something that game-changing. And, the odds of that happening, very, very slim. Could it? Sure. But definitely something to watch out for. But, for now, keep in mind these tendencies. Seasonally, no real tendency around this time of year. Volatility tendency is that a day like yesterday is somewhere smack in the middle of a bear market. Not the end, not the beginning, but somewhere smack dab in the middle. Thanks for hopping on. Hope you're having a great holiday week, enjoying time with your family, friends. Have yourselves a great one, and we'll talk to you later. Take care.